Hello, everybody. The topic of discussion this weekend is a topic which is something very much connected with so many of the non-resident Indians, and especially all the non-resident Indians who were once upon a time in India and have got a lot of connect with India in terms of investments and in terms of the times which they spent in India. The topic is, should an NRI avail insurance in India? And that too, we want to do a complete analysis from investments, Indian taxation, and foreign tax compliance viewpoint. The first and foremost thing when we discuss any insurance is that one needs to ask one's own self that am I insured properly or not? As far as our non-resident friends who are in the developed markets, they very well understand the need of insurance and they are very well covered in their respective countries in terms of the life insurance coverage per se. We are not talking about the investment part or any other angle, but when it comes to pure life insurance, the non-residents in the developed markets are quite very well covered insofar as insurance is concerned. But when it comes to our non-residents in the emerging market, especially in the Middle East and Africa, they are at times very much dependent upon their coverage in India and they are not adequately covered. So when it comes to getting oneself insured, that is something which is very paramount, and every person, not just non-resident Indians in a particular jurisdiction, everybody should give a lot of importance to see that this human asset, which is earning money every day and able to maintain the family on a day-to-day basis, is adequately covered insofar as life insurance or not. Then the other aspect of life insurance is that so many life insurance policies are coupled with investments. So there is an element of insurance, obviously, and also there is an element or a substantial element of investments. To add to that, in India especially, there is an element of income tax planning which is involved insofar as life insurance is concerned. The reason is that in India, there is a provision under Section 10, subclause 10, capital D, which states that if in respect of any insurance policy, the first year premium is say a lakh of rupees, 1 lakh rupees, and the life insured or the sum assured is say 10 lakhs of rupees, which is 10 times. So the sum assured is 10 times of the first year premium. Then whatever are the proceeds which are received by way of a claim under that policy or by way of any investment return under that policy are completely tax-free insofar as Indian taxation is concerned. So this acts as a major tool for tax planning as far as India is concerned. Over and above that, whatever are the insurance premiums which are contributed or paid during the year, to the extent of 1.5 lakhs, that amount is deductible from the income of that respective individual. So to the extent of 1.5 lakhs, I'm going to get a deduction out of whatever is my taxable income in respect of that particular year. Now let us understand broadly what could be the major insurance plans which somebody should be looking at as far as India is concerned. The first type of plan which anybody should look forward is a term plan. A term plan is a very simple way of looking at insurance, which is a pure insurance, pure life insurance. If you die, you pay a premium, and if you die, you are going to get a certain amount of money. To add to this pure term plan, there are certain additions or elements which are added, or certain features which could be added, which could be that there could be a critical illness rider. Under that critical illness rider, if the insured comes across through or is inflicted with a critical illness, then all the future payments of premiums could be waived, or he might receive a certain sum of money as per the whatever are the conditions in respect of that particular policy. But this is a feature which is available in quite a few term plan policies. Then some people feel that whatever is the premium that I am contributing towards life insurance premium is something, and if nothing happens to me, then that entire money is a dead loss to me. So they find it a little uncomfortable. For those people, there is a kind of a policy feature in this term plan policy is that you could get a return of your premium which you have contributed across the entire policy period. So whatever are the premiums which have been contributed over a period of, say, policy premium payment period of, say, 5 years, 10 years, 15 years, 20 years, the entire money would be returned back to the policyholder. Obviously, the premium in such kind of a feature wedded or feature coupled policy would be on a little higher side. But these policies are very important for everybody to have at least a basic where there is no element of investments involved, but it's a pure life insurance, and anybody who has not availed appropriate amount of life insurance should go for these kinds of term plan policies in India, and they are offered at quite an attractive rate of premium in India. And so many of the foreign insurance companies have partnered in India, and they are offering these kinds of plans. We have also come across through certain non-residents saying us that the insurance premiums in India on these term policies are on a lower side, but that depends upon each different countries. It might not be true in respect of every other country. Then the another kind of insurance which somebody can look forward to, where there is an element of investments involved, is a unit-linked insurance plan. Under the unit-linked insurance plan also, in order to get the tax shelter, initially, as what I said, that the insurance premium is, say, 1 lakh and the sum assured has to be 10 lakhs. So if it is a 10 times sum assured, then whatever are the proceeds which are received under that insurance policy, may it be the claim on insurance, on a death, or any return on investments, they are absolutely tax-free. And this unit-linked insurance plan offers a very interesting, a very efficient tool wherein one can invest into equity-based investments. Within equity-based investments, so many classes of equity-based investments like large cap stocks, mid cap stocks, multi-cap stocks, and so many options. And also debt-based options, say government securities, bonds, corporate debts, so many kinds of debt options as well. So within one single policy, one can have an option of investing into different kinds of these investment avenues, and moving from one investment avenue to another investment avenue at any point of time. And in most of the policies, it is without or with a very, very small cost. And in most of the policies, I would say it is without any cost. So what happens is that the entire investment is under one umbrella of insurance, and you can move from different types of equity options within that umbrella of that plan, and also to debt options without triggering any tax liability. Or in most of the jurisdictions in India, it is absolutely tax free, as I said. But in most of the jurisdictions, because there is nothing which is received on maturity, these investments movement within the umbrella of one single insurance plan would not invite even foreign tax compliance. So this at times act as a very efficient way to manage tax affairs for non-resident Indians. Then at times this insurance policy, which is the unit linked insurance policy, can also work as a pension plan, in the sense that I contribute for 5 years into that insurance policy, and after 5 years I can start withdrawing a small sum of money for my monthly expenses, and that entire withdrawal is completely tax free in India. So whatever are my withdrawals on a monthly basis, I can withdraw from that corpus, and I can continue withdrawing from that corpus, and it can be planned in the manner that the insurance coverage or the sum assured remains the way it is. And also there is a small withdrawal for the pension needs of an individual. So it can work as a combination of an insurance cum pension plan. And above everything, one of the most important and the attractive aspect of this kind of policy is that on a long term, which is say around say 7 to 10 years time frame, the cost of running this kind of an insurance policy is akin to or little lesser than even the other options of investments like a mutual fund. So with one umbrella, one investment in one insurance policy, one can avail the benefits of quite a few different investments with the least or no compliance, and use it as a just not like an insurance policy, but also as a pension policy. Then the third species of insurance policy which somebody can avail in India and which is very attractive is guaranteed return insurance plan. Under the guaranteed return insurance plan, what happens is that once again, we should go for a 10 times sum assured. So as I said in earlier instances, and I repeat once again, that even under this plan, my say insurance premium is 1 lakh of rupees and I'm insured for 10 lakhs. So whatever happens in terms of returns or whatever is given back to me in terms of returns is completely tax-free for me. So the moment I am done with that 10 times insurance cover and I'm paying a premium for say some 5 years, 10 years, 15 years, then I can avail an insurance policy wherein the payment of a specified amount can be guaranteed at the rate of somewhere between 5 to 6% per annum, and that guaranteed amount of return can be for a period as long as 15 years, 20 years, 25 years, and at times even for the lifetime. So if there is a mechanism where somebody would say that in India, I can avail an insurance plus a guaranteed return, which is a promise, which is going to stand for a long period as 15, 20, 25 years, and that too at a decent rate of 5 to 6%, it is something which is, in my understanding, quite attractive. because even in India, the interest rates are on the falling trajectory. Now, this is insofar as the different kinds of interesting and attractive insurance plans are concerned for non-resident Indians. Now, what are the major considerations which at all points of time when you are selecting any of these plans should be? The first and foremost, do I need life insurance at a certain age? At an age of say 25, 30, 35, 40, 45, even 50. Yes, I do need insurance because I've got certain liabilities I'm earning and I have got obligations towards my family. But if I've reached the age which is quite ripe, I am say retired, or I'm not contributing, or there aren't so many dependents on my income, then I need to look into that, do I really need insurance and I need to incur the cost of risk premium or not? Then the other aspect one needs to take into consideration is that when it comes to investment returns, then what are the returns net of costs? Because there is a cost involved as far as life insurance is concerned. As I said earlier, there are plans which are quite attractive and extremely cost efficient, but there could be an insurance option which might be expensive and not worthwhile when it comes to investment returns. So this thing has to be kept in mind, and proper advice and proper understanding of any insurance plan which somebody is trying to go for should be done before really entering into the contract. Then one needs to assess that what is the kind of tax advantage that I am looking at. So the tax advantage could be in terms of lesser amount of payment of taxes in a particular jurisdiction, and maybe there could be a tax liability in some other jurisdiction, or may not be a liability in some other jurisdiction. Then what is the extent of support in terms of lower compliance that I'm going to get? So these are the major considerations which somebody should look into while going for any insurance policy, and they should take proper advice and understand in depth, in detail, the pros and cons and the features of a particular insurance policy. With these words, I will open the house for question answers, and any questions on any of the topics which are maybe connected with this subject, or anything which a non-resident Indian in terms of investment, insurance, Indian taxation, foreign tax compliance, whatever they like, they can ask. They can either put their question in the chat box, or place the button of raise your hand, and my office will coordinate that question with me. Please.
Good evening, Mr. Kothari. How are you doing?
Fine, great.
Great, okay. I have a quick question, which is not regarding the insurance, but I have a PIS account, and whatever sales proceeds I have, the bank deducts the TDS from there. So whatever money is left over after that, which is in an NRO account, how it can be transferred to the NRE account, and how long it takes normally.
Right. Whatever is the balance in an NRO account, those balances can be transferred to the NRE account after payment of appropriate taxes what are due in respect of the monies which have accumulated in the NRO account. So if these amounts were the proceeds of disposal of equity shares in India, whatever is the due tax, and if that tax has already been deducted by way of a withholding tax or a TDS, then that part of formality is already done, and those monies can be transferred from the NRO account to the NRE account, or outside of India, or an account of your choice within no time. And that is just by completing certain formalities, and it doesn't require any approval or permission. A certificate by a chartered accountant in respect of that funds is good enough. It needs to be uploaded, bank needs to be informed about it, and those monies can be seamlessly transferred to the extent of $1 million per person per year.
Okay. And how long that formality takes? Like, suppose I request you to do that for me, how long it takes to get the certificate?
1 day.
1 day, I see. Okay, great. Thank you very much. You answered my question very well. Thank you.
Hello. Hello.
Yep.
Yes, there is a question from Mr. Rajendra in the chat box, and he is asking for that he is an NRI and he is having a property here in India, a not immovable asset, and he is about to sell that property. So can he adjust the gain with the amount of tax with the any of the insurance policy he can consider to buy here in India? So is it possible?
Okay. As far as the deduction from insurance is concerned, it is available on incomes like interest income, business income, or those kinds of income. These incomes which are in the nature of capital gains, which you are talking of on disposal of a property, they are taxed at a flat rate, and hence the deduction on contribution towards life insurance under Section 80C is not available. So you need to pay that flat rate of tax. There are obviously certain deductions which are available on disposal of any immovable properties under other provisions of the Act, but contribution to life insurance, that is not a deduction which could be available against the income which we are talking of on disposal of on the disposal of immovable property.
Okay. And Mr. Rajendra is also asking for how he can reduce, like apply for the lower TDS or nil TDS certificate before he sells sell off his property here in India.
Okay. Say when a non-resident Indian sells any immovable assets in India, immovable properties in India, if under Section 195 of the Income Tax Act, that the payment, the entire consideration would come up for deduction for that TDS at the rate of 20% plus surcharge plus cess. In order to avoid that, what the non-resident can do is that he can file an application for lower tax deduction before the income tax authorities and can claim that this is the actual amount of long-term capital gains which would rather be taxable in respect of my proposed transfer of immovable asset. And that is the amount on which tax deduction at source should be done. So on the application, and that can be an online application, a person who is, say, the seller of the property can make an online application or seek assistance from any consultants in India and can make an application and thereby obtain a certificate for lower tax deduction. And it normally takes around a month's time to be on the safer side, it might take a lesser number of days. But if you have got a period of around 1 month, it should be a safe period to really get that certificate and be operational, because at times there are a little questioning or back and forth exchange of emails. There is no personal appearance for anybody to be made before any authorities. The entire process is online, and you need to execute an agreement to sell, so that the entire consideration, the buyer, the seller, the entire deal is completely on the record. And on filing of those things, the lower tax deduction certificate can definitely be availed. Yes. Mr. Vinod.
Hello, may I ask you a question?
Yeah, please go ahead.
Okay. My Demat account, which is I have with the stockbroker, is a joint account with my wife. And I actually opened that investment. And now what has happened is the first name is my wife's name and my name is second name.
Hmm.
Okay, so when we have the proceeds of the thing, in India, it is considered that that is her account. And over here, we are filing separate returns. So can it be distributed when you are filing the return for me? Can be distributed between both of us, the dividend as well as the proceeds?
Strictly legally speaking, yes, it can be distributed. It depends upon who contributed this monies at the time when this investment was made. If the contribution was made by both of you and the first name was just of your wife, then
Yes.
it can be distributed. But practically, it will become rather difficult, or it will not be workable. I will tell you why. Because what would happen is that the moment there is a disposal of any asset, there is a withholding tax which is deducted. And then when the withholding tax is deducted, that is deducted in respect of the first account holder always.
Yes.
So the reporting that will go to the income tax department would go that this person who is the first account holder has disposed a certain amount of assets, and this is the amount of gain which is accrued in respect of that disposal. So thereafter, if we file a tax return which is contrary to this, wherein we will be claiming that the proceeds need to be taxed on a 50-50 basis, then it will definitely invite explanation from the income tax department.
Okay. Right now, what I'm doing right now is whatever dividend I'm getting, it's a large sum of money I'm getting. So over here, my accountant is distributing between us, both of us, because I explained that this is a joint account. And over here, there is no problem about first name. But in India, I'm talking about,
But I'll tell you, there will be the best route that you should be following is that open another account wherein you are the first holder and she is the second holder, and distribute these amounts between both these accounts. Otherwise, what would happen is that when you would be filing your tax returns in Canada, you will get a credit under the double taxation avoidance treaty in her case only because her taxes have been paid in India. And you would not be getting any credit on account of the double taxation avoidance treaty, despite the fact that you are bearing half the liability of payment of taxes on that income. So the prudence would say that you better distribute those amounts between both of the accounts. The fact is that this is the way the monies actually belong to. So that will make life easier and things will be a little more easy for compliance.
Okay. Thank you. These stocks have been sitting there from 1980s. And now, it's time for me to dispose them off,
And these stocks can be transferred from one demat account to another demat account as well. So then thereafter, if the disposal is made, then things become a little easy.
When we transfer it, like suppose we distribute between the two accounts, then is it considered as a disposal of the shares? No.
No.
I see. Okay.
No.
Because I have over here, I had some stocks sitting which were not registered. And then I put it in the account. They say, okay, this is considered as a sale of the stocks, and then I had to pay the tax on that.
Okay. What we should be doing is we can claim it as a gift. In India, any gift between a husband and say wife and husband, it is free. So spouse, either ways, it is free. And in your case, if that is a transfer, it is basically returning back which you actually did not own. Basically these amounts, as you can prove that these were the amounts which were transferred from Canada when you bought these shares, which was out of a joint account. So she was holding on your behalf. It's just returning back something which she was not as such entitled to.
Well, this investment was done when I was in India. And it was a joint account. Of course, it was joint account, but now tracing those accounts would be very difficult. I don't think so. But it is a fact, like everything what we own here in Canada and India, everything is on a joint name, That's what we started, and we are keeping same way.
Right.
Thank you. Your webinars are very, very informative, and thank you very much for that.
Thanks for joining.
Daxesh, I have a question. Amish here.
Hello.
How are you?
Fine, great. How are you?
Good. Sorry, I joined in a little late. I was outside. Just based on what the person from Canada just asked a question, I wanted to figure out what is the gift amount that one can gift in terms of share, the value. And is it the current value that is considered, or is it the face value that is considered? What is it that one can transfer without getting taxed, without the other person getting taxed, or without me? What are the tax implications?
There is no bar on the amount, or there is no threshold, maximum threshold, which is the amount beyond which there is some tax implication or anything. When in India, if there are certain relationships which are defined relationships, say gift to a spouse, gift to brothers, sisters, and so many of the relationships, but there are a limited number of relationships. And in respect of that, whatever are the amount or the amount of shares or any amount which is transferred, it is completely tax-free. But at times when it comes to shares, it doesn't make a lot of sense, or there is not a lot of a great reason to make those gifts. The reason is that irrespective of whichever head you would be paying tax on those disposal of those shares, it is at a flat rate. So if I dispose shares in my hands or my wife disposes those shares in her hands, it doesn't make any difference, because as such, I am supposed to pay a flat rate of tax. So unless it is not required for whatever reasons between, say, brothers, if there is some partition, or say, sons and whatever XYZ relationship, that's okay. Otherwise, as far as tax planning is concerned, it is not very much required, because anyways, it's a flat rate of tax.
Okay, thanks. Thanks.
Hello.
Yeah.
Sir, can you please just explain it once again that what is ULIP, and does ULIP is better than any other investment?
The simple thing is that ULIP acts, unit linked insurance plan, which is the short form of ULIP, acts as an umbrella wherein you can invest into different kinds of investments, may it be debt-based investments or equity-based investments. In case of, say, mutual funds, you need to have different funds, transfer from one fund to another. It would entail some kind of a taxation and compliance. While as if you have investment in a unit-linked insurance plan, you have an insurance, and also there is an umbrella, or there is a corpus which can be shifted from debt to equity, and different classes of equity or different classes of debt, as per the need and as per whatever is the trend of the market and need of the investor. And these transfers within this corpus or within this umbrella of investment under the policy would not entail any taxation at all. The taxation would happen at the end of the tenure. But as I said, that if in case, if the first premium, if the sum assured is 10 times of the first premium, then whatever is the amount of corpus which is received under the insurance plan is completely tax-free.
How it is better than any other investment?
It is better in terms of compliance and in terms of a tax shelter which it would provide. In terms of compliance in foreign, if somebody is making any foreign tax compliance, it is not required, in my understanding, to whatever are the transfers which happens within the umbrella or the corpus, they are not required to be reported, because nothing is received as such from the insurance policy, and it is tax-free in India for the reasons which I mentioned.
Sir, how many types of pension plans are available in India for NRIs?
There are pension plans which are available for non-resident Indians in India. So those pension plans, whatever are the monies which are received under the pension plan, would become taxable in India, because there isn't an element of insurance. But if we cover it through insurance and it acts as a pension plan, as I explained earlier, then it can work as a tax-free pension plan. As far as pension plans per se specifically is concerned, there are, if somebody wants a sustained income and taxation is not an issue, then a return on a pension plan could be assured for at least a period of 20-25 years, and a lump sum could be contributed straight away, and a sustained income can be availed for a long period of time, either immediately after the payment of that contribution towards the pension fund, or after a gap of say 5 or 10 years. And these returns are for a long period of time in the range of 5 to 6%, which is an attractive rate, which is an assured rate for the entire tenure.
Okay. So maybe we can say that this option we can consider against like NRI FDs.
Yes, it can be an option which can be very much considered against NRE or an NRO FD because as such that income becomes taxable in India because pension is taxable in India. But if in case if somebody is paying any taxes in some other jurisdiction, then these amounts of whatever taxes they would get as a credit under the double taxation avoidance agreement, and hence anyways you are supposed to pay tax even if it is a income from an NRE fixed deposit. It is tax free in India, but then it is taxable in other jurisdiction where somebody is a tax resident. So NREFD is taxable, but there the interest is assured or the rate of return is assured for only for a period of maximum say 5 years. Here what can happen is that this pension can be assured for a long period of 15, 20, 25 years.
Okay.
So that makes it an interesting product. And for those people where anyways they are paying taxes in their home country on NRE or an NRO income, this becomes an interesting option.
Okay. Thanks.
If there is an NRI who is comparing a NRE deposit in India and insurance plan and is looking for a fixed assured return for a very long term, then what is your take? Which one is suitable and advisable?
Of whatever facts that you have narrated, that those monies are for a long period of time, and he wants an assured return for a long period of time. And I would add that if that person is of an insurable age, if somebody says 60, 65 years of age, naturally that's not an age where somebody would be by and large insurable, and it would not be worthwhile going for insurance. But if somebody is of the age till say 50, 55-ish, then it makes great sense going for investment, tax-free investment in India through the insurance route under a guaranteed insurance, guaranteed income plan of insurance, wherein you can get somewhere between 5 to 6% return depending upon the age. And that return, I repeat, would be assured for at least 15, 20, 25 years, depending upon the plan. So any fall in the interest rates at a later date, I would not be impacted. So
that's too tax-free.
That too tax-free. So that makes it an interesting or an advantageous avenue. Please unmute Mr. Rajveer. Mr. Rajveer.
Can you hear me now?
Yes, sure.
Okay. Good morning for me and good evening for you. I'm right now in Colorado, USA.
Yeah,
I'm doing good. So I missed some of your seminars because of the time difference. So morning here, it is now 6:15. So today somehow I could manage a little bit of time. I had some pending questions, if you can throw some light. One is that, how can one Indian resident help his kid, son or daughter, in, purchasing a residential property in India? Maybe by giving him a gift or a loan, or how he can, if a son or a daughter wants to buy a residential property in Ahmedabad or somewhere.
Okay.
That's my question.
Definitely, a resident Indian can gift to the extent of $250,000 per year. So $2.5 lakh, a resident Indian can give a gift. A resident Indian can give a gift to the non-resident, and that person has to be a close relative. Definitely a son or daughter is perfectly fine. So parents can gift to the extent of $250,000 per person per year, and from those proceeds, property can be bought in India.
How much, to what extent did you say? How much is that limit?
$250,000.
Okay, that LRS, what is that LRS limit?
Yes, yes, yes.
In that one, that what is that TCS and all, which they have started from this October, will it be applicable? No.
No, this is as such not a LRS payment, but the cap $250,000. The cap, it is not a payment under LRS.
So he can transfer money from his saving bank account to his NRO or NRE account?
Yeah, NRO account.
Not NRE, right?
Not NRE.
He can anyway open an NRO account. Okay, that's a good question. Then what is the tax implication? Suppose I am being a green card holder. I want to procure some property in US, okay, in my own name or in the name of my son. So how can I go about it?
Okay. Say if you can, you are a Indian resident under FEMA, that is what is important. So a green card or not holding a green card or whatever. If you are in India and
as a taxpayer, yes.
Yeah, taxpayer, and you are a person who is in India and who is by and large in India for an uncertain period, and you are just a visitor in US, your green card or anything would not matter. So you are a Indian tax resident and also a resident under FEMA. The moment you are a resident under FEMA, then that LRS limit of $250,000 would apply, and that would be a limit across gifting to your son and buying a residence in US and transferring funds out in US. So it will means limit of $250,000. Either you can gift it to your son in India in the NRO account, or you can rent to US and buy a property out of it.
Okay, suppose I remit it. So in that one, this tax which has started now, that TCS, will it be applicable?
Yes, that TCS would be applicable because this transfer will be under LRS and hence it would be applicable. But I would like to clarify for everybody that this is not a tax for good. This is just a TDS or a withholding tax. Whenever you're paying your Indian tax return, you can claim the set-off of this TCS. This is not gone forever. So whenever you're paying your Indian taxes and whatever are the tax collection at source, which is TCS in respect of that LRS, you can definitely claim a set-off. And if your income is not liable to tax, then you are going to get a refund out of it. Transfer of funds from India has not become taxable. The government just wants to...
And maybe they wanted everything to in record. Somehow some channel should be there where they can do some tracking or something probably. This is what normally government is supposed to do also. So that's a good, it clarifies some of my doubts. So good, good seeing you after a long time, and I'm right now in a situation where traveling is not possible. Otherwise, in winter, I normally am in Ahmedabad. So maybe after a few months, I'll be back there and see you.
Okay. But you are in Ahmedabad, we'll definitely catch up and meet. And so nice attending.
Yeah, it's always my pleasure meeting you. Thank you. Thank you, Daxesh bhai. Okay, chalo, bye.
Hello.
Yeah.
Hello.
Yeah.
Sir, how the NRI can apply for the life plan without coming there to India? Is it possible without any medical verification?
Normally, all the life insurance policies, and if they are of anything which is of substance, then they would require a medical checkup from the insurance company side. That is something which is a standard requirement. So if a non-resident Indian is visiting India, that definitely is very much an opportune time for going for life insurance policies in India. And that acts as something which is extremely convenient. But in these times when people can not travel so easily, definitely one can avail life insurance being at the place where they are presently located. And there are ways and means whereby a particular hospital or a particular clinic would be assigned wherein that non-resident Indian needs to visit for that medical checkup, if at all it is required. Otherwise, everything in India in respect of the life insurance policies is absolutely on a electronic basis, and all these formalities can definitely be completed without any hassles and personal presence of somebody who would like to go for any life insurance. So if it is definitely possible without anybody visiting India, and especially in these challenging times.
Okay, thank you.
Since we have got participants from across the world, from developing economies as well as developed economies, say US, Canada, Middle East, Africa, what would be your suggestion as far as life insurance are concerned? Which type of policies would be suitable to what kind of non-residents based in different countries?
Yeah, that's a very interesting and a very pertinent question. So my take is very clear on which all policies could be suitable for which jurisdictions. When it comes to people or non-resident Indians who are in the Middle East or Africa, term plans are the first and foremost thing they should be going for. At times, there are several countries in Africa where the Indian insurance companies are not comfortable giving somebody any term plans. So there one has to go for a ULIP, unit-linked insurance kind of a plan, where the sum assured might be little on the lower side, but there is an investment element involved, and it requires a certain kind of fact-finding and persuasion with the insurance companies, because these countries in Africa carry a certain level of risk. But the most important part is that everybody who is into especially these two major geographies, they need to go for a life insurance, especially on the term plan side. And if they've got investments, then they can go for the investment oriented products, which is also an attractive thing, especially the unit linked insurance plan. And if we have got monies which are for NRO, NRE fixed deposits, then they can go for an excellent option, which is that guaranteed income insurance plan. So that is insofar as both these geographies are concerned. When it comes to all the different geographies which are developed markets, there one thing is very clear, that there is going to be a lot of compliance on the taxation side which would be involved. So any monies which are tax-free in India not necessarily be tax-free into their jurisdictions. And it would entail compliance when you're making an investment in India, say in an NRO or an NRI fixed deposit, or for that matter into a mutual funds or in some stocks, it would entail compliance on a year-on-year basis. Whereas if somebody is investing through a unit-linked insurance plan kind of an option, wherein the entire corpus is under an umbrella of insurance, and you can move back and forth your debt and equity and different options, which I have said earlier. And in that kind of a scenario, there is no compliance, which is, in my understanding, would be required into those developed jurisdictions. Only when after the policy terminates after 10 years, 15 years, 20 years, then that one-time compliance would be required. So that is an attractive way of managing investments in India without attracting any compliance in India or outside of India in that entire intervening period of 10, 15, 20 years.
Thank you. We have a question from Mr. Rajveer.
Please unmute Mr. Rajveer. Oh.
Can you hear? Okay. The question is a secondary question to what I asked earlier. The TCS, which you said, gets a credit while you're filing the thing. Can it be carried forward, this thing? Suppose this year it's more than what, tax. So can I get the refund this year, or it is to be carried forward, the TCS?
Yeah, you can definitely get a refund. It is like any TDS. It's just like a withholding tax or an advance tax. If you don't have any income, or if you have income which is not liable to tax in this year, this is very much refundable. No problem.
The same year itself. And another, the question was that suppose my son or daughter doesn't have an NRO account right now. So can it he open from staying in US, or one has to visit? What is the requirement for opening an NRO account?
If they have got NRE account in India, that very bank can definitely open the NRO account quite easily, because they have three other requirements insofar as the KYC requirements are concerned. That was known to the bank, and it's just opening another account for a particular individual who is already their client.
Already KYC is there. Okay.
KYC is already there. So it should be quite easy. And even otherwise, even if you don't have an account which is operative in India, there are banks which open account on an eKYC basis, and it should not be a problem. But the existing bank should be extremely comfortable opening an NRO account in India.
I see. Okay. Okay, good. Thank you. Bye.
Bye.
Daxesh, I have one more question on the insurance.
Yep.
So in the event of an unfortunate event, and the insurance money is due to the bereaved or the family, that amount which is being received, you're saying that it needs to be taxed?
No, it would not be taxed if the amount of first premium, say you paid a premium of say 1 lakh of rupees to start that policy, and the sum assured is 10 lakhs. Then that entire amount, whatever is received under the insurance policy by way of a claim or a return on the investment which is embedded in that policy, entire money is tax-free in India, whatsoever, howsoever big that amount is.
Okay. And again, the person who gets the money, right? is based on the will that has been prepared. So whoever's receiving as per the will, whether it could be the spouse or whether it could be the child, does not get taxed for whatever amount that is being received.
Perfect. And as far as an insurance policy is concerned, the entire proceeds on a claim are paid to the nominee. Then whatever has been mentioned under the will is a matter intercede between the nominee and the beneficiaries under the will. As far as the insurance policy is concerned and the insurance company is concerned, monies would be paid to the nominee in the first place. Then whatever is mentioned in the will is something which the nominee, who is as such the custodian of that money, has to do in accordance with the will.
Right. Okay. Thanks for the clarification.
Okay.